working with private capital can be incredibly liberating. It's a lot less restrictive than bank finance because your investors, who are business people, can be negotiated with. So your terms and conditions are quite flexible. The issue with private finance is that it often is hard to access unless you've got experience or credibility. In this quick educational, I'm going to share with you how you can structure terms with an investor, how the profit splits would look, and how to mitigate your risks so that you can continue to build and hold on to your reputation.
I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low income multi-let residential market.
So private finance is really great if you want to be doing more of your commercial deals where the banks don't really like to lend or lend with unfavorable terms. The problem is that it requires credibility. It's very hard to go to somebody and say, hey, loan me R1 million to buy this investment, because the person's going to say, that's fine, but prove to me that you're capable of using my money. Show me a case study. Show me a deal where you've done this before. What did you learn? What were the mistakes? What were your returns? If you don't have case studies or some experience, it's very hard to go to an investor and say, please lend me. Unfortunately, that is just the case. So what usually happens is that you'll have to do a couple of deals risking your own money, maybe using bank finance, or maybe you're privileged enough to go to mom and dad or to family, or to maybe you've got a wealthy network. So you can maybe try with them, but as soon as you want to go to an independent investor, they're going to require a case study. So use the bank's money to do a couple of deals, risk your own capital first, and once you've got a model that works, then approach private investors. And the great thing about private investors is that you can negotiate terms and conditions that are favorable to you. So the most important thing to look out for with private finance is credibility. I've been able to do several deals and blocks of flats using other people's money, but it took time. It wasn't just a done deal. It wasn't really easy to do. In fact, this is the timeline that it took me to really start getting good at raising private finance. So if we look at 2013 to 2018, that was a 5-year period. Those were the first 5 years of my investment journey. I was able to do 4 deals. I raised 2.15 million in capital. Majority of that was through bank finance. I had a bit of family money, or money that I could raise from my family, being my sister. And then I had one angel investor loan, 1.35. So over a period of 5 years, I was able to raise 2 million rand, bank finance through my sister, and then I had one angel investor, one private investor who luckily believed in me, and I was able to make a purchase. So over 5 years, that's all that I did. Then in 2019, this is now 6 years into building credibility, into having I've got four deals, 4 case studies that I can now show the world. I did 5 deals in this year. I raised 2.8 million in finance. 800 was through a commercial bank. 1.5 was through a partnership model, and then 500,000 through angel finance. In 2020, I did 3 deals, raised 1.75, mostly through a partnership of 1 million and a bank loan of 750. In 2021, this is obviously the year where COVID was hectic, so I only did 1 deal. I was a bit trying to figure out where the market was going through partnerships and angels. And then this year, 2022, I've been able to raise 8.5 million for a block of 27 units. 7 million being associated with partnerships and 1.5 in angel. And I don't put these numbers on to brag or to impress you, but to rather impress upon you that raising finance is a skill, and it takes time to mature that skill. So I would have never thought, when I started out in 2013 to 2018, the first 5 years of this business, I would have never thought that I could raise close to 10 million in 1 year. But this year was my year. I was able to really get quite lucky. The funny thing is that I raised all my finance off the back of my YouTube channel, which is just crazy. I had people reach out to me after watching a video and saying, I like what you're doing. I've got 500,000, I'm looking to invest it. Yeah, I think the point I'm trying to make here is that it takes time to build up your reputation, to build up your credibility. And once you've done that, it becomes easier to raise finance. So if you're in the starting stages of your property business, don't be too hard on yourself if no one's willing to invest. Try use bank finance. Try maybe approach people who know you and trust you and willing to give you a break. But if you're willing to commit 5, 6, 7 years and getting good at this and building up a small portfolio, you can then approach private investors and use their money. So private finance requires trust and credibility. That's the most important thing. I know I've said it a couple of times. I promise I'm going to move on now. So the terms. There are 3 things that you have to look at when you're working with an investor. You have to structure the agreement with the investor. This can either be via a loan agreement or an equity stake. Depending on the structure, you're going to have a way in which you split the profits. You're either going to pay an interest if you're doing a loan agreement, or you're going to pay dividends if you're doing the equity model. And this really comes down to risk. Are you working with a low risk investor? Are you working with someone who's willing to be a little bit more exposed with a high risk scenario? So if we break down the structure, you've either got a loan agreement, option 1, an equity partnership, option 2. So within your loan agreement, the returns are fixed at an interest rate. It's a shorter time frame. I wouldn't recommend going over the 5 years unless you believe in the deal and the numbers still work. So it's more or less your shorter time frame. Oftentimes when you're doing like a flip, is very comfortable to do a loan agreement because you need some bridging finance for 6, 12, 18 months to pay for the renovations. You're going to sell in 2 years. So you'll create a 2-year agreement. You loan the money, you pay them a bit of interest at the end of the 2 years. When you sell your property, you pay back the capital. It's a great strategy to work with. Now, your loan agreement is for your low risk investor because they're not taking any risk. Their interest is fixed at, let's say it's 12%. They're going to get their return regardless of how the asset performs. You as the jockey, you as the operator of this deal, you're taking the risk. You're hoping that there's enough profit in the deal to cover the 12% and still have some left over for you. The equity is now when the person's bought into the business vision and they are going to have returns variable to performance. So when the asset does well, you as the operator does well, but also your equity partner does well. If the deal goes pear-shaped and there's a loss, you as the operator take the loss, but your equity partners also take the loss. So if there's a negative cash flow for one of the years, you and all your equity partners have to fund that agreement. So this is definitely more your higher risk and your longer term partnerships. This is when you want somebody in your deal for 5, 10, 15, 20 years, and it's more for your higher risk guys with higher risk appetite and thus also higher returns expectation. So you really have to understand your investor. What is their preference? Now, I like to think of an investor in one of 2 ways. You've either got your active investor or your passive investor. Your active investor is someone who wants to be actively involved. They understand the property game. They've got some experience. They're willing to contribute not only capital, but also time and experience, and they are more suited for your equity model. Your passive investor, this is someone who just wants a passive return. They want some exposure to the property market. They don't really understand the property business, but they understand business as a concept. They will contribute capital and maybe some experience, but not really time. This is when I'm going to push for the loan agreement. Now, selfishly, when I'm looking at a deal, I want to sell as much loan as I can. I don't want to give away equity. For me, giving away equity is very valuable. So I'd rather, when I'm speaking to an investor, I'm going to say, my first option is a loan agreement. I'll pay you 12% guaranteed for 3 to 5 years. If that doesn't work for them and they're not willing to buy in, then I go the equity route and I say you can get a portion of the profits. So if we break down the loan agreement a little bit more, your structure is loan, your profit split is interest, your risk is low. Now, your loan agreement, it's the same as you would think a bank loan, right? You're going to have the amount, you're going to have the interest rate, and you're going to have the term, right? So in this example, this is a 20-year loan with the bank. You can see that you're slowly paying off the debt by paying capital and interest. That's not necessarily what I would say is the best term. You don't want to do a 20-year term with an investor. Let's say that you've got a situation where you've got a need for 200,000. So you need to raise 200,000. You need to determine how much you're going to raise from which investor, what the period's going to be, and what the interest rate's going to be. So of your 200,000, you approach two investors and you say, investor one, I want 40% of the 200,000, and investor two, I want 60%. So from investor one, investor orange, you need to raise 80,000. And then from investor two or investor blue, you need to raise 120,000. So on the one, you're going to apply a 15% interest rate. On the other, you're going to apply an 18% interest rate. And then you're going to apply different terms, period of when this loan will be repaid. So 2 years and 5 years. Now, what you're seeing at the last column there is the monthly repayment to service that agreement. So for investor orange, you're only loaning 80,000, but because you're loaning it over a 2-year period, you're paying more than the person who you're loaning 120,000 Rand from, which is crazy. So as you start to fluctuate your interest rate and your period of terms, you'll see what your bond repayment is. That's when you have to go back to your deal and say, what can my deal afford? Okay, my deal can afford the 15%, but it can't afford the 18%. And that's how you can start to offer terms to your investor. Obviously, your deal has to be able to finance this. It has to be able to afford it. But when you're working with your investors, you have to decide what the period's going to be, what the term or the interest rate's going to be. And you could be quite flexible with how you pay back your investor. Your structure is not, the banks always say you have to pay principal and interest over 20 years. You can't really negotiate. You can't go to the bank and be like, hey, Absa, I'll pay you back in 15 years, but I'm only going to pay interest for the first 5 years. They're not going to work like that. Whereas an investor is a lot more negotiable. And there are essentially, in my mind, 3 different structures you can follow. Structure 1 is similar to how the banks operate. You pay monthly interest and capital. So, I've used an example here. Let's say you're going to loan R1 million over a 10-year period. Every month you're going to pay 14,347 Rand. And at the end of the 10 years, you've paid back your debt and you guys both walk away in your respective terms. So, that's not really attractive for me as an investor. I might as well just go to the bank and get the same terms. The other way you could do it is you could say, I'm going to pay you monthly interest every month, but I'm only going to pay the capital portion at the end of the term. Okay, so now in this situation, you loan the R1 million in 2020. Every month you're paying your 10,000 Rand, which is just your interest portion. And at the end of the year, you pay back your million. Okay, so now what you're doing here is for the 10 years, you've reduced your monthly debt repayment by 4,347. So now you've increased your cash flow. Okay, you obviously need to make sure that at the end of the 10 years, you've got that R1 million. So you're either going to refinance the asset to pull out the R1 million and pay back the investor, or you're going to sell the asset and then you're going to pay them back. So make sure you've got the R1 million at the end of the term to pay them back. The third and probably the most attractive is to say, I'm not going to pay you anything for the 10 years, but at the end of the 10 years, I'm going to pay you both interest and capital, right? So you get the R1 million in 2020, you pay nix for 10 years, and at the end of the 10 years, you pay the 1 million, which is their capital, plus you pay their interest portion, which in this case would be 1.4 million. So again, that's really great because your cash flow is going to be a lacquer for 10 years because you've got no debt to pay. But at the end of the term, you've got this 2.4 million Rand payment that's expected. So how are you doing that? Are you refinancing? Are you selling the asset? Are you going to save up the capital to eventually pay them? It's great to reduce your debt and not have to pay any monthly debt, but make sure that you can still honor your agreement at the end of the term. So that's the loan agreement. That's attractive if you can find favorable terms with your private investor. Some investors don't want a loan agreement. Some of them want equity. They want a piece of the profits. So here your structure is equity, your profit split is dividends, your risk is high. This is sometimes referred to as a joint venture partnership. Okay, so I'm going to use an example. Let's say you've got a building and you want to bring 3 partners into this building to be able to afford it. But you need to now figure out, how am I going to do profit split? How am I going to do shareholding? All right. Ultimately, you have to figure out 2 things. Who's going to put in the money? Who's going to put in the time? Those 2 both have value that then equal to equity. So starting with money first, let's just say that this commercial building is going to cost you 2 million Rand, and you've got 3 investors lined up. You've got investor A, B, and C. Now, investor A has got 200,000 Rand. Now, if you need 2 million and they've got 200,000, they've essentially got 10% of the capital required to make this deal happen. So they should technically get 10% of the profits, right? That, in my mind, is a very fair way in which you can do this. You give 10% of the capital, you get 10% of the equity. Investor B is going to give 1 million. So he's giving 50% of the capital required, so he should get 50% equity. And then investor number 3 is putting in 800,000. So that's 40%. So if it was just money, it would be easy to work out what is the fair share. But it's not just money, because there's also a time component to this whole thing. Right? There's also managing of tenants, managing of renovation, managing of accounts. You know, there's a lot of work that goes into managing. Now, if you're just putting in capital, let's say there's 2 people, right? There's me and one other guy. He puts in all the capital, but I put in all the work. Now, he's put in all the capital, so he's getting 100% of the equity. I'm putting in all the work. Where's my share? That's why you can't just look at money. You have to look at time. So here I've just assumed that you're going to put a 10% management fee on the deal. That's what the common rate is. So of the rent collected, 10% of that rental income is allocated to those contributing time and adding value on operating this thing. So let's say investor A says, I'm going to put up my hand and I'm going to manage the tenants. Now that's going to take about 20% of the total time required to manage this asset goes towards tenant management. So investor A should get 20% of that management fee, right? Then we've got investor B. He puts up his hand. He's a CFA, and he says, I'll do the accounts. And that's now allocated to 50% of the management fee. And then we've got investor C who says, I've got some experience in renovations. I'm happy to manage that. So I'll maintain the building at 30%. So of your 10% management fee, 20% goes to investor A, 50% goes to investor B, and 30% goes to investor C. So now it's quite easy to see who gets allocated what based on not only the money they've put in, but the time that they've done. So your shareholding and profits is split, right? Investor A gets 10% equity in the deal plus 2% of the management fee. Investor B gets 50% of the profits plus 5% of the rental income as a management fee. And then investor C gets 40% of the profits or 40% equity plus 3% of the rent collected. So now each person has been fairly compensated for the capital they've put in by getting a shareholding. Plus now the people who are actually managing and running the building also get a management fee. So I've used this as an example. I mean, obviously in my case, I do all the management. So I take the 10% management fee, plus I put about 10 to 20% of the capital into a deal. So I always get 10 to 20% equity in a deal, plus I get the 10% management fee. That's what's in it for me. You don't often have it that all the shareholders are contributing time. Usually your investors are giving capital and you're the one managing it. So that's why you'll take majority of the management fee. But I just wanted to show you how you must think about this. There's money and there's time, and each person must be fairly compensated. Once you've got this thinking done, you obviously need to get everything in writing. You need to get this in writing and get all your shareholders to agree. You need a dividends policy, a valuation of shares, division of labor, or division of roles and responsibilities. Once you've got these agreements together, that's when you can, really start to expand. Now, private finance is something that I do on a regular basis. Once I've got somebody off my YouTube channel that's expressed interest in meeting me, I take them through a slide deck. I present deals. I'm constantly selling people on deals. Which is great, it's exciting, but also you have to remember that you're using other people's money now. So I have a vested interest in somebody else's success, because if I make a success for somebody else, they're going to likely give me more money. Whereas if I don't do that, if I make them lose money, how likely is he going to come back to me and give me more money? This is where risk mitigation comes in. You really have to make sure that you're protecting the interest of your shareholders, because a happy shareholder tends to give more money. So when we're looking at risk mitigation, you've got to protect your income, you've got to contain your expenses, and you've got to have an exit strategy. So protecting your income, how can you increase income? Can you put some commercial advertising in there? Can you add more rooms? Can you charge for parking? when you're containing expenses, can you put in prepaid meters, prepaid water, prepaid electricity so that you can contain those expenses? Can you add a monthly cleaning service that will then reduce the amount of maintenance that you need to do? Because instead of having to, repaint the whole house every 2-3 years, you've got a cleaning service that comes in and does regular maintenance. And then an exit. Can you flip it? Can you multi-let it? Can you change the zoning? Private finance is when you use other people's money to invest in property. It's a very good source of funding if and only if you have credibility and experience. Because you're using other people's money, there are 4 pillars that I live by. Number 1, transparency. Show them everything. Show them the proofs, show them how you've analyzed what your feasibility is, what the risks are. Put everything on the table so that they make an informed decision. If things don't pan out and the deal goes a bit sour, at least you can go back to your original conversation and say, guys, we all made the same decision with the information we had at hand. We didn't know that COVID was coming. Like that, one of my deals did go a little bit south because COVID took 40% of the rental income out of the picture. But when I went to my investors, they were very understanding because when we made the first assessment pre-COVID, these were the numbers. And now the numbers have returned because COVID was a blip on the radar. It came in and it came out, and we've recovered from that situation. So be transparent and open upfront with your investor at all times. Liquidity. Don't take on more debt than your deal can afford. There's no point in bringing on a whole bunch of investors and it's negative cash flow, because what you're gonna have to do is go to your investors and say, guys, we need to fund this deal. Give me more money. That's not a good place to be in. Not a good place. Trust. It's more important that you do a good deal because it builds your reputation. Every time you do a good deal with a shareholder, they're likely going to give you more money to play with. And then meet their objectives. Right? Your interests are your shareholders' interests, because the more you build your reputation, the more money you can access from them. So make sure that if they're expecting a 12% return, that your deal can afford it. If they want an equity model, make sure that they understand what the restrictions are. Like, I'll often tell my partners that for the first 18 to 24 months, don't expect any dividends. Because the first 2 years of buying an apartment block is towards fixing it up, making sure it's got good tenancy, so that when we go to the banks, we can get good terms on our refinance. So for the first 2 years, don't expect any money. And follow the principle of underselling and over delivering, because a happy shareholder is one that tends to give more money. So private finance, the biggest restriction is that it requires credibility. But once you've got that, you can be very flexible with your terms to make a good deal for not only you, but your shareholder as well.
I hope you enjoyed that video. Give it a thumbs up if you did. Please go and check out my YouTube membership. You get access to exclusive content. I'll also analyze live deals on your behalf. So go check out my YouTube membership for that and so much more.